Real estate market is undergoing a massive shift, one that investors, property owners, and even those who simply rent or own a home will soon feel in profound ways. The storm that Warren Buffett has been warning about is no longer just a forecast, it is beginning to hit. And if you're not prepared, the consequences could be severe. Don't forget to subscribe for more insights on the real estate market. The $1.4 trillion problem. How cheap debt has fueled the real estate bubble. For more than a decade, interest rates in the U.S. have been at historic lows. From the 2008 financial crisis all the way up until recently, the Federal Reserve kept the federal funds rate close to zero. This made borrowing money incredibly cheap. Banks were lending freely, and investors were eager to take advantage of these favorable conditions, including in the real estate market. The result was a surge in property values, particularly in the commercial real estate sector. Real estate investors, whether they were large institutional players or smaller private investors, were buying up office buildings, shopping centers, apartment complexes, and other commercial properties with the help of massive amounts of debt. This strategy was particularly attractive because of the low cost of borrowing and the expectation that property values would continue to rise. However, property purchases in commercial real estate were often financed through non-recourse loans, which means that the borrower is not personally liable for the debt if the property goes into default. These types of loans are common in large commercial deals, allowing investors to take on substantial debt without risking their personal assets. If things go south, the worst-case scenario is that the lender takes back the property, but the investor walks away with minimal losses. But what happens when property values start to fall and the loans reset at higher interest rates? The impact of rising interest rates. Interest rates are no longer at historic lows. The Federal Reserve has recently raised interest rates to combat inflation, and the cost of borrowing has risen substantially. This is where things start to get tricky for property owners, especially those who took out loans during the era of cheap debt. In commercial real estate, interest rates on loans are variable, meaning that the interest rate resets after a few years. Unlike mortgages for residential properties, which often have fixed rates for 15 to 30 years, commercial loans usually have shorter durations, often ranging from 3 to 5 years. This exposes commercial property owners to the risk of rate hikes. Let's use an example to break this down. Imagine a commercial property worth $1 million. The owner purchases this property by putting down $350,000 in equity, the down payment, and borrowing $650,000 from the bank. At an interest rate of 5%, the owner pays an annual debt service of $32,500, which is affordable given the property's income. Let's say the property generates $60,000 in annual rent income, and after expenses, the owner has a debt service coverage ratio, DSCR, of 1.85. This means the property generates nearly double the income needed to cover the debt payments, which is a comfortable position for the investor. But what happens when interest rates increase? If the interest rate on the loan rises from 5% to 7%, the debt payment jumps from $32,500 to $45,500. The property's income has not changed, so the investor's ability to cover that higher debt payment has become much more difficult. And if the interest rate rises further to 9%, the annual debt service balloons to $58,500. At this point, the property's income of $60,000 might just be enough to cover the payment, but the financial situation is much tighter than before. Now, let's add another layer to this scenario. The demand for office space has dropped due to the rise of remote work. Let's say that the property's income falls from $60,000 to $40,000 as tenants vacate and leasing rates drop. In this case, the owner will not be able to cover the debt payment, and the property is likely headed into foreclosure. The looming foreclosure crisis. The real estate market is facing a potential wave of foreclosures. With $1.4 trillion in commercial real estate debt coming due over the next 12 to 24 months, many investors are at risk of losing their properties. This isn't a hypothetical situation, it's already happening. Take the example of Starwood Capital, one of the largest real estate investment firms in the world. Recently, Starwood defaulted on a $212 million loan tied to an office building in Atlanta. The building, once considered a prime piece of real estate, is now struggling with only 60% occupancy, down from 90% when the loan was originally made. The property had lost so much value that Starwood decided not to negotiate with the lender to save it. Instead, they handed the keys back to the bank and walked away. This is just the tip of the iceberg. More and more investors will likely face the same fate, walking away from their properties as they can no longer service their debt. While the buildings themselves won't disappear, they will change hands, and the owners will lose out. Who will bear the pain? On the surface, it might seem like the major Wall Street banks, who often lend large sums of money for real estate purchases, would be the ones to take the hit. However, the reality is that regional and community banks are the true lenders in the commercial real estate market. Small and medium-sized banks make up roughly 2/3 of all commercial real estate loans. These banks have taken on significant risk by lending to real estate investors and property developers. When these loans go bad and properties are foreclosed upon, it won't be the big banks that are left holding the bag, it will be these smaller institutions. And this is where the real economic ripple effect comes into play. These smaller banks also lend to small and medium-sized businesses that are crucial for the economy in smaller cities and towns across the country. If these banks suffer significant losses from their real estate portfolios, they will likely pull back on lending to businesses in general, which will lead to a credit crunch. What this means for the broader economy. The impact of this looming real estate crisis won't just be confined to the commercial property sector. The broader economy will feel the repercussions, especially in sectors reliant on small and medium-sized businesses. These businesses provide the backbone for many local economies, and if they can't access credit, it could lead to a slowdown in economic activity. The slowdown in commercial real estate could also affect other industries indirectly. For example, construction companies that rely on new real estate developments will likely see a decline in demand. The same goes for industries connected to office and retail spaces, like furniture and maintenance services. The interconnectedness of the economy means that one sector's downturn can have a domino effect on many others. The real estate market is a critical driver of wealth in the U.S., and as commercial properties lose value, so does the overall wealth in the economy. This could lead to slower economic growth, higher unemployment, and a decline in consumer confidence. A storm brewing. The U.S. real estate market is on the cusp of a major shakeup. A massive $1.4 trillion in commercial real estate debt is coming due, and with rising interest rates, many investors are poised to face significant losses. The effects of this crisis will not only be felt by property owners, but by the broader economy, especially in small businesses and local banks that are heavily tied to commercial real estate. Don't forget to subscribe for more insights on the real estate market and expert investment strategies.